Come to chapter 1 of corporate finance. I know corporate finance or finance subjects might not be majoring subject for your program. Nevertheless, I'm gonna guide you through the entire lecture classes throughout the semester. Don't think is tough subject. It's not a tough subject, and it's not something totally new because most of you already have the basics of finance. All right, you would have learned this in personal finance subjects, and this is just advanced from whatever you studied before. All right, so whatever you studied in your personal finance or any finance subjects, you're going to bring that, you're going to bring forward the knowledge to this subject, corporate finance. All right, so don't think it's totally new. It's always something you've already learned before. It's just a bit of advance from that. All right, anyhow, we're going to go through all the basics. Okay, so let's start with chapter 1. Chapter 1 is an overview of the financial management function and environment. Okay, chapter 1 is a crucial chapter. The reason is because we're going to learn what are the core topics. Okay, by knowing the core topics, you will understand what are the topics that are going to be followed through after this. All right, let me start with, all right, the next slide. Okay, first, corporate finance. Corporate means business. All right, so we're going to be focusing more on business finance compared to personal finance. Right, so our tutorials, our questions, or our tests will be more on business related questions compared to personal finance. Okay, as you can see here, three images followed by three names, which is investment, financing, and dividend policy. All right, class, take note, this is an important slide. The reason is because these three topics, core topics, going to encompass, all right, it means it's going to be repeated throughout your 14 weeks, throughout all the other chapters, because any other chapters you're going to learn from now on, chapter 2 until chapter 14, is going to come under one of these topics. All right, it's either investment, it's either financing, it's either dividend policy. So these are the three core topics you're going to learn. All right, so let's begin with investment. All right, what is investment? As you can see the image, all right, hope you know what is the image. All right, this is Petronas Twin Towers. Okay, what is investment? Petronas owns this building, Twin Tower. How do they come out with this building? All right, how do they own the building? They have to need what? They need money. All right, so that is called investment. At that point of time, they might need, let's say, 1 billion worth of money in order to build this entire building. So that is called investment. So investment means a company invests their money, invest their funding in order to purchase assets, right? It could be purchasing a building like Twin Tower. All right, you can buy another building, you can buy factories, you can buy a shopping malls. All right, and you can buy another company as well. That is called investment. All right, so the first core topic would be investment decisions. And the next core topic, equally important, is financing. As you can see the image on the top, all right, that's a currency, the sign of currency, and there are some cash out there. So what is financing? All right, financing means how do you get the funding for Petronas to build 1 billion worth, or maybe now it's 2 billion worth of Twin Tower, the building. Where did they get the money? How did they raise the funding? All right. So financing means what is the source of fund? How do you get the money? All right. As a student, all right, you have expenses. How do you get the money? If you ask what is the source of your finance, you would say your parents. Or you could say your PTPTN loan. So that is called financing. All right. So financing, we talk about source. Where did you get the money from? Okay. So there are two major sources of financing that we're going to learn in corporate finance. Those are, take note, debt and equity. All right. So what is debt? Debt is called borrowing. All right. Taking loan from banks, all right, from other companies, all right, it's loan, borrowing. So that is one major source of finance. Another major source of finance is, can anyone guess? That is equity, all right, shares, all right. For a company, especially listed companies, they get the funding from the shareholders, people who purchase shares from your company, they become the shareholder. All right. So remember, under financing, the two major source of financing is debt, which is you get borrowing. All right, debt. Another one is equity, the money you receive from your shareholders. All right. So you need the funding so that you can invest. Whether you want to buy assets, whether to run a company, you need financing. All right. So to invest, you first need financing. So these are the two major topics. And let's go to the third one. All right. It's called dividend policy. Okay. What is dividend policy? You know, you have to make decisions what kind of assets you're going to purchase. All right. Is it long-term asset? Is it fixed asset, current asset, or non-current asset? Then you have to decide how I'm going to finance it. And the third one is also important for a finance executive. All right. It is called dividend policy. What is dividend policy? A company at the end of the year, once they make profit, they have to distribute the money back to the shareholders, right? But of course, you can say it is not compulsory. Dividend, it is optional. So that is also a decision. A company has to make a decision whether they want to pay out their profit as dividend or they want to keep the money in the company as a retained earnings. All right. So companies have to decide how much they're going to give out a dividend. Is it 50% from the profit, 20% from the profit, or no dividend at all? So that is the company's decision or the finance director's decision. All right. So class, as you can see here, these investment financing dividend policies are the core topics. The next chapters, that's the following chapters, will come under investment, financing, or dividend policy. So these are the core topics. So later on, of course, in each chapters, I will let you know that particular chapter comes under which core topics. So can always refer back to understand, all right, systematically. So with that, we shall move on to the next slide. All right, so let's start with the chapter outline. right? Once we look at the core topics, let's look at the outlines. So what we're going to learn in this chapter further would be the nature and the goals of financial management, introduction of corporate finance and its purpose, stakeholders and key decisions of the financial management, and also introduction on some of the securities traded in Bursa Malaysia. Okay, all right, let's move on to the next slide. All right, okay, as you can see in the diagram, all right, class, okay, you have to take note, this is an important slide as well. The reason is the three core topics: investment, financing, and dividend decision. All right. So those three images, or these three core topics, has been broken into more information, more details here. All right. So ultimately, if you ask a company, the director, what is your ultimate motive? Why are you running a business? So they would say the main purpose of a company is to maximize the value of the business. All right, to maximize. If your company is worth 100 million today, what is your goal? You want to make it 200 million next year. You want to make it 500 million the following year. So that is your purpose of a company. That's your vision, to maximize value of the business. All right. In other words, you can also say maximize shareholders value. All right. So these are the um, two common um, vision statement. Okay, they usually use. Uh, the ultimate purpose of a company is, they would say, maximize shareholders value. All right, or maximize the value of the business. It's the same. So how you're going to maximize your company's value? You have to make three key decisions. All right, three key decisions. I just give you a brief overview of those. Let's look in detail what they're talking about. So number one would be the investment decision. So what is investment decision? As I said, invest investing means purchasing, acquiring assets. So invest in assets that earn a return greater than the minimum acceptable hurdle rate. All right. Uh, Acceptable hurdle rate, here they're talking about the cost of capital. All right. The hurdle rate means cost of capital. So class, what is cost of capital? Cost of capital, there's entire chapter on cost of capital. So in brief, cost of capital means if I give you 10,000 as a loan and I'm charging you let's say 7% interest. The 7% interest is the cost of capital. All right, no one gives you money for free. So what do they charge in return? That is called cost of capital. So your investment decision ultimately must earn more than your capital. If I give you 10,000, I'm saying I'm charging you 7%. All right, interest. You take the money, you take the 10,000, you invest, and you get more than 7%. You get 8%. That means you're making profit. If you're taking the 10,000 and you're making 5%, that means you're losing. All right. So remember, investment decision has to make more money than your cost of capital. All right. So we're going to look, of course, in detail on the cost of capital chapter later on. So remember that the important decision is you make more money than your cost of capital. All right. So as you can see below, here they talk about hurdle rate. What is hurdle rate? What is cost of capital? All right. Cost of capital should reflect the riskiness of the investment. All right. Investment can be very low risk, very high risk, or medium risk. So your cost of capital has to reflect that. If you're taking a very high risk investment which is risky, then your cost of capital will be higher. All right, and then it has to reflect the mix of debt and equity. All right, if I'm investing 500,000 in a new project, how it is funded? Is it 50% by debt? Is it 50% by equity? Is it 70% by debt, 30% by equity? So based on that, your cost of capital will be reflected. All right, so that is hurdle rate or cost of capital. And then let's talk about return. The return should reflect the magnitude and the timing of the cash flows. Magnitude means the size, right? The size, how big is the return? Are you going to get the return like 20% of your capital the first year itself, or you're only getting 5% of your capital the first year? And then the timing of your cash flows. All right, timing of your cash flows, how fast you recover your capital. Is it in the beginning year, or you're only getting back the major portion in the 10th year, 15th year? All right, so this will reflect your return. All right, so both cost of capital and what kind of return you're going to receive will be important for you to make investment decision. Okay, so that's about investment decisions. Let's move on to the second key topic, which is financing decision. Okay, so class, financing, I hope you still remember what are the two major sources of finance: debt and equity. All right, so find right kind of debt for your firm and the right mix of debt and equity to fund your operations. So if you want to invest 500,000, where do you get the money from? How do you going to source the money from? Is it you going to take a loan? Is it a long-term loan? Is it a short-term loan? All right, or are you going to ask the shareholders to fund for the investment? All right, so that's your decision. So your decision will also reflect the optimal mix of debt and equity. All right, so class, again we're going to learn about this topic in detail. That's a chapter on financing. Okay, so we usually companies won't take 100% debt to fund an investment. They will mix it. They will have certain portion of equity and certain portion of debt, because there is some benefit out of it. So we're going to learn about that later. So the company will make that decision by mixing the right amount of debt and equity. All right. So thumb rule. Usually they say thumb rule is 70% equity, 30% debt, or 60% equity, 40% debt is kind of an ideal mixture. Of course, it depends on every different types of investment and the companies. All right. And the next part is the right kind of debt matches the tenor or duration of your asset. Means if you're buying a non-current asset or fixed asset, you're going to match it with long-term financing. All right. If you're taking a current asset, you have to match it with short-term financing. So that is the right kind of matching. You don't want to buy, let's say, a building that you're going to use for 50 years by taking short-term loan. So you have to match it with a long-term financing. So this is the matching. All right. So this is the combination of debt and equity, and here what kind of asset and how it's going to be sourced. All right, we talk about duration. So that's about financing decisions. So let's move on. Third one, the dividend decision. All right, this is interesting. If you read this, all right, can you read this? Alright, so class, what does it say? If you cannot find investments that make your minimum acceptable rate, return the cash to the owners for your business. Which means if shareholders giving you funding and they say every year you give me back 10% return. So whoever invests 100,000, they want 10,000 in the form of dividend. Alright. If a company took the money from you and they can't give you back 10% as you requested, alright, let's say they only make 7% from the funding you give, then it is better to give back the money to the shareholders. Right? Don't keep the money, don't invest in a investment that give you lesser return, lower return than required by the shareholders. All right, that is what it means. Don't keep the money, don't keep the money just like that without investing, nor investing in a projects that give you lower return than required by the shareholders. Right? You rather give back the money to the owners. Okay. So how much cash you can return depends on the current and potential investment opportunities, which means you make a profit, all right, lucrative profit end of the year. How much you're going to give out the profit out as dividend? You're going to distribute. How much you're going to distribute? You're going to distribute 80% of the profit, 100% of the profit as dividends, or just 10% profit out of dividend. Depends on your investment opportunities. All right. If you have great investment opportunities, you don't give out your profit out as dividend. You tell to the shareholders, I'm keeping the money so that I'm going to invest further, all right, to increase the company's wealth, to expand the business, all right. So it depends on investment opportunities. If you don't have any investment opportunities, you're already in the matured industry, you have lots of cash, then you pay back more dividend, all right. So usually developing companies will keep more of their profit and retained earnings, while those who are established companies, they pay more dividend. Right? So how you choose to return cash to the owners will depend whether they prefer dividends or buybacks. Okay, another important aspect as well depends on the shareholders, whether they want return in the form of dividends or they prefer the company to buy back the shares, right? So that is another topic on we're going to see a lot on this, whether shareholders prefer to take cash dividends or they want companies to buy their shares. All right, share buyback. All right, it's the same thing, they're still getting the money, but the concept is different. Okay, so with that, I'm completing this slide. All right, you can always refer the slide back, all right, after on the following chapters, because again many of the topics will come under one of these key topics. All right, so let's move on to the next slide. Financial management. Okay, what is financial management? All right, so you should know, you would say, if you ask your parents or anyone doing business, it's like, what is financial management? It's about how you manage your company's money. All right, how do you manage it? So here are the functions, three key functions that you need, that you're required in order to manage your finance well. So what are the key functions? Let's look. Number one, allocate funds to current and fixed asset. You have funds, you're going to allocate the funds to buy current, or how much current asset you're going to purchase, how much fixed asset you're going to purchase. So this is the key function, this is the first function, and this function comes under class. Can you guess which key decision or key topic. This is the investment decision. All right. Allocate funds to current and fixed asset. This is the investment decision. And the second, obtain the best mix of financing alternatives. Yes, that's right. That's a financing decision. All right. You're going to choose which is the best sort of financing. And then the third one, of course, develop an appropriate dividend policy within the context of firm's objective. That would be the dividend policy. So investment, financing, and the third one is your dividend policy. All right. So let's move on. Let's look at the objective of decision makings. So because we have three major decisions: investment, financing, and dividend policy. So let's look at the objective. So in traditional corporate finance, the objective is to maximize the value of the firm. All right, you're making all these decisions in order to expand the value, increase the value of your company. Right? If it's 100 million, you want to make it 200 million. Then you want to make it 300 million, and so on and so forth. So even a narrower, right? Even more specifically, you can say it is the objective is maximize shareholders' wealth. All right. This term, I'm sure you would have heard this before. All right. This commonly used maximize shareholders. Any company, you say, what's the objective? What's the purpose? They would say maximize shareholders' wealth. All right. When the share is traded and the markets are viewed to be efficient, and the objective is maximize share price. All right. So this is the goal, maximize shareholders' wealth. But how do you know the company has achieved that? So you look at the share price. All right. If it's like a public listed company traded, then you know if the share price from $1 increased to $1.20. All right, $1.50, that you know the company is achieving the goal, which is maximize shareholders' wealth. And the indicator is the increase in the share price. All right, look right below, as you can see, all right, this table, all right, assets, liabilities, all right. This is, if you remember in accounts, is your balance sheet, your assets equals to liabilities. All right. And the liabilities here, of course, you have debt and equity. Okay. So let's look about maximize firm value. So maximize firm's value means we're talking about assets, the assets of the company. So here there are two assets. One is assets in place, another one is growth assets. Okay, what is assets in place? So this is based on existing investment, what the company currently have, okay, and generate cash flows today. So when you have assets, those assets are generating cash flows, and then includes long-lived and short-lived. Okay, what does it mean? Long-lived assets means non-current assets. Okay, building, factories, vehicles. All right, those are fixed assets. The next one, working capital, is the assets that are required to operate the business, the working capitals. Okay, like trade receivables, cash, right, the bank balance, all those are working capital. So this is assets in place. Okay, what about the next one? Growth assets. Expected value that will be created by future investment. All right, so class, if a company, for instance, if a company, let's take Gamuda, all right, Gamuda Berhad, they already got a government project to build a new highway, let's say, all right, they just received agreement of contract. They haven't, they have not started building yet, but do you add this in your assets? Yes. All right. When you secure government projects, that will shoot up the company's value. Your share price immediately will increase. All right, because the this is known as growth asset because it will increase your company's value in future. So you have to incorporate that or make it accountable as well. Okay. Next would be liabilities. Okay, under liabilities you have debt, where fixed claim on cash flows. Fixed claim on cash flow means when a company take loans, they have to make fixed payment. Okay, do they have a role in the management? Uh, Precisely no. Okay, they don't involve in the company's management. Do you have fixed maturity? Yes. All right. Most of the loans, when you take a borrowing, you take for certain specified duration. I take a loan for 5 years. If you take a car loan, it could be for 7 years, 9 years. For housing, it could be 25 to 30 years. So you have a specific duration. And of course, the next point is tax deductible. It's a very important information because for that, when you take loan, you have the interest you pay is tax deductible. All right. So this is about debt, and let's talk about equity. So accounting equation, which is assets equals to liabilities. All right. Assets equals to debt and equity. Okay. So assets minus liabilities or minus debt, you will get equity. So residual claim. Class, can anyone know what is residual? Residue, maybe you studied it in biology. All right. The residual means remaining the balance, right? So the residual claim on cash flows, which is we're talking for a shareholder from the asset, you minus whatever the liabilities the company has. Okay, the remaining amount all belongs to the shareholders. All right, that's why I say residual. After minusing debt, whatever remaining, all right, let's say a company is worth 100 million. All right, the debt is 20 million. So remaining 18 million is equity. So the company shareholders can take 80 million. They cannot say I own 100 million. No, you still have to pay the debt, all right? Pay the borrowers. So the remaining is your residual claim or remaining is your equity. So if your value of equity increased from 80 million to 100 million to 200 million, that means you are maximizing shareholders' wealth, all right? So you can either look at the maximize firm's value, right, to know whether the company is growing, or you can also look at the shareholders wealth. All right, ultimately both are showing whether the company is successful, performing better, or not performing. All right, so with that we move on to the next slide. All right, this is maximizing stock price, maximizing share price is too narrow an objective, a preliminary response. Okay, uh, there can be some connotations, there can be some kind of view why you're talking about maximize share price alone, right? What about other objective? Why are you only talking about the maximizing share price? Isn't it too narrow? All right, is it just focused only on the shareholders? What about other stakeholders? All right, it could be a view by certain groups. So, what is the response to the statement? All right, so let's look into this. Maximizing share price is not incompatible with meeting employee needs and objective. Why? All right, so here the response is maximizing share price does not mean it's not giving any good to the employees. All right, does not that doesn't take care of the employees. It does. How is it? Employees are often shareholders in many firms, especially the staffs, the key executive staffs, the directors. They are also the shareholders of the company. All right. So sometimes they get option uh, shares in the form of options. All right. And the next thing, firms that maximize share prices generally are profitable firms that can afford to treat employees well. So what does it mean? Can a unsuccessful company, can a company that fails, do you think they can care their employees? Do you think they can give good bonus? Do you think they can pay on time? No. Only when the company is successful, when the share price is increasing, that means the company performs well, they can able to take care the employees as well. All right. And then you have the second point, which is for customers. All right, maximizing share price does not mean customers are not critical for success. All right, why? When you talk about maximizing share price, how do you think a company's share price increase? When a company's share price increase means the company has to do well, the revenue has to increase. All right, the company business has to expand, and the only way the company achieve that is by satisfying the customers. By making customers happy, they're going to purchase more of your products. Ultimately the company going to grow. All right, so having this objective will ultimately help the customers, of course. And the third one does not imply that the company has to be socially outlawed. All right, what is socially outlawed? Going against society. It is not. Why? When a company who performs well will give more employment opportunities in a country, all right, in a state wherever they are, all right, in a location wherever they are. So ultimately, what you can see here is for employees, customers, for the society as a whole. Do you think maximizing share price not giving benefit to the stakeholders? No. It is benefiting each and every stakeholders. All right. Successful company will make all other stakeholders uh, benefit, get the benefit as well. So then why do we have only this maximizing share price? The reason we have only one goal is easy for a company to adapt, to follow, to focus upon. All right. If you have maximized employees' needs, maximize the customers' needs, maximize the society needs, you have too many goals. All right. When it's too many, you can't focus on. So you need one single objective that the company can focus on. Ultimately, can bring success to everyone, every other stakeholders as well, not just the shareholders. All right, with that, let's move on to the next slide. Why traditional corporate financial theory focus on maximizing shareholders' wealth? All right, let's see. The first point, easily observable and constantly updated. All right, class, if I tell you, ask you to check for a return on equity, all right, or net profit margin of a company to determine whether the company is successful or not, can you find it immediately? Right, it's not that easy, right? You will wait for the financial statement of the company, usually quarterly if you're a listed company. If not, end of the year only once. So you can only calculate the ratio once a year. But you look at the share price. If I ask you to check uh, the share price for, let's say, Maxis, you can instantly check. All right. because it's easily available, observable, and is constantly updated. You check the price today and tomorrow the price, even every moment the price will be reflected. So that is the main reason we are focusing on share price. And then if investors are rational, so share price will also reflect the wisdom of decisions. All right, the shareholders, are they investing for long term or they investing for short term? So your share price will also reflect on the ideology that the shareholders have. And all right, so the third objective of maximizing share price is all right. This is the again the three main decisions. Let's say investment decisions, financing decision, and the third one is dividend decisions. All right, these three decisions, these three function is important to determine how are you achieving your objective. All right. All right. Let's move on to the next slide. All right, so here we look at the classical objective function. All right, whose objective? This is the financial manager's objective. Right. So what are the role? What are the role of the financial manager? The role of the financial manager against other stakeholders. All right. So let's look at the first one. All right, the first one would be the role of the manager towards the shareholder. And what is a shareholder's role towards the managers? All right, it's a two-way role, a two-way functions here. So what is the manager's role towards shareholders? They have to maximize the shareholders' wealth. All right, that's the ultimate goal. The company owned by the shareholders. All right, so managers who work for the shareholders, we have to make the company grow. All right, so that's their manager's goal: maximize the company owner's wealth. What about the shareholders' role towards managers would be to hire, to appoint, and terminate the managers, all right, the board of directors in the annual general meeting. So they will hire and fire the managers. So that's their role. Let's talk about bondholders, all right, bondholders class. One important source or one important type of debt is bond. All right, so we're going to learn a topic on bond itself. All right, important topic. So bondholders or lenders, we say like when Maybank gives you company a loan, Maybank become the lender. All right, so bondholders, lenders, they lend money to the company. The managers have to protect their bondholders' interest, which means they have to pay back their interest on time and also the capital. All right, you have to pay back the capital on time as well. So what about the financial market? If your company is listed, you have to reveal information honestly on time. So let's say Bursa Malaysia, all right, the capital market. And the capital market, on the other hand, have to reflect the value of a company efficiently. Okay. What about society? Do society have any rules when it comes to a company's managers? No, there's no. Um, sorry, there's no social cost for the managers towards society. It means company doesn't have any specific role that they have to do for society. All right, but what about society? Society can always blame. If anything goes wrong, they say, all right, this company, all right, they don't do the products good quality. All right, they are polluting, so they always uh, blame the company or the managers for any wrongdoings. All right, so that is the objective the managers with other stakeholders and the stakeholders role towards the managers. Okay, let's go to the next slide to see what can go wrong. Shareholders towards managers. What can go wrong is sometimes shareholders might end up have little control over the managers. All right, the other shareholders might not be in the office day in day out, so they might just go there once a year on the annual general meeting. So they might not know what's going on in the company. So they might have little control over the managers. And then the managers, of course, they can put their interests as the priority compared to the shareholders. So they want to maximize their own wealth. All right, they want to maximize their bonus, maximize their salaries, perks, and allowance compared to maximizing shareholders' wealth. Okay, what about bondholders? They lend money. That's all they do. But bondholders can get ripped off. All right, some of the managers, let's say corrupted managers, financial directors, they can rip off the company. The company can go into bankruptcy. Okay, financial market, usually the company will delay the bad news or any misleading information. The good news will tell the market immediately, but the bad news they will keep it. They will inform it later, because once you inform a negative news, of course the share price will negatively reflect. All right, so we'll delay the news. Let's say, for example, a um, key person in a company is no longer in the company. It's like uh, let's think Tony Fernandez. Let's say he's no longer in the company. He left AirAsia. That's a negative news for the company. So they might inform it later compared to uh, on time. All right. So markets can make mistakes as well. All right, can overly react or can underreact, and then so the society, the managers might have significant social costs. All right, if there's a pollution, they might end up have to pay huge amount of penalty. All right, and some costs cannot be traced to firms. So some things that been some pollution. All right, that can be done. Uh, uh, let's say some companies are doing some pollution, we might not know that is done by these fellows. All right, so that is something you cannot trace back. So these are the things can go wrong. Okay, let's move on to the next function of the financial managers. All right, so here you have your goal. That's quite straightforward. So you know your financial manager's goal to maximize shareholders wealth. So how are you going to do it? You have roles on a daily basis, occasional basis. On a daily basis, you become a credit manager. You manage your credit. All right. Credit management means, are you paying your suppliers on time? All right. You bought inventories from them. You bought stocks from them. So are you paying on time? The next one, inventory control. Do you have sufficient inventories in a company? All right. You have too much or too less. Receipt and disbursement of funds. Do your customers paying on time? You have to check, you have to monitor that, and also dispersing the funds to your supplies. All right, so that is daily basis. The next one is occasional basis. You don't do this on daily basis. For example, issuing shares. You want to issue new shares, you do maybe uh, 2 years once, 5 years once. All right, depends on the company's needs. If there's no need, then some of the companies don't issue new shares at all. All right, and the next is bond issues. All right, company wants debt, so they issue debt. So this also is not a daily basis. They might do it, you know, a few years once. And then capital budgeting. Capital budgeting means you have limited fund. How are you going to use the fund? All right. You have, let's say, 1 million. What are you going to use? What are you going to purchase with the 1 million? Are you going to buy a new machinery? Or are you going to buy a new factory? Are you going to invest in different projects? So that is called capital budgeting. And then, of course, dividend decision usually once a year. All right. End of the year, once you close down your accounts, then you will decide from profit how much you're going to pay out your dividends. So that is occasional. And the last one, profitability and risk. Okay. You cannot be too greedy, only thinking about profit by end up taking too high a risk, or you are just too much concerned on risk. At the end of the day, you're making little profit. So you have to balance this profitability and also risk in order to achieve your ultimate goal. So you have daily goals, occasional goals. In the both ways, you have to trade off your profitability risk. That will ultimately achieve your goal, which is maximize shareholders' wealth. Okay.